My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. What would this market look like if we had a coronavirus vaccine and everything went back to normal? Well, it would look a lot like today, with the Dow Jones average skyrocketing 530 points, S&P surging 1.23%, NASDAQ advancing 0.17%, up much more at one point before more saber rattling with China. All sorts of beaten down stocks, though, roared higher, while the COVID-19 winners, well, they got slammed. There's just one tiny problem with this action. We don't actually have a vaccine. Now, does that mean the stock market is getting ahead of itself? Okay, let's unpack the issue. First, this rally is based not just on the hopes of a vaccine, but on a firm belief that the whole virus problem isn't nearly as dire as we thought. A lot of people feel that it's been blown out of proportion by the media, and the president's right, the people feel the president's right, when he says we should open up everything. Betting on a vaccine makes sense. Since the beginning of this pandemic, medical experts have warned us that developing vaccines take a long time. The fastest was the mumps vaccine, which took 4 years ago. But every day we're bombarded with news about another attempt to end this nightmare. Today we heard that Merck's working on a magic bullet using technology that they developed when they were working on the Ebola vaccine. Everyone got excited. Merck's got a great reputation. The fact that they're getting involved is a pure positive. Meanwhile, we also learned that Novavax has started human trials for its own COVID vaccine. Novavax has already seen its stock soar more than 1,000% year to date, even though the company's never actually been able to deliver a successful vaccine. So you got Merck, you got Novavax, you got Moderna, Pfizer, Glaxo, Sanofi, Regeneron, J&J, Oxford University, and scores of others. And they're using like great technology that we heard from Jensen Huang on Thursday night from NVIDIA. So you got a ton of terrific companies that are pouring resources into beating this thing. Plus, they've got much better technology than they had even a decade ago. Think about this. They can sequence the whole coronavirus genome. They can use artificial intelligence to model potential vaccines virtually in order to eliminate dead ends. We didn't have any of that stuff when it took 4 years to develop the mumps vaccine in the 60s, so the comparison is just not relevant. Time frame. When you have a conservative outfit like J&J talking about the first quarter of 2021, and they also have the ability to be able to produce billions of the vaccine, I believe that things are rolling along nicely. If we can beat this thing early next year, that's huge. But still, we got to get through the next 6 months without it, and I don't know about that. Which brings us to the other piece of the puzzle, the reopening. Many Americans simply aren't willing to wait anymore. It's the social distancing stuff. They're like done with that. Outside of the New York metro area, we're not seeing the kind of huge outbreaks that could shut down local healthcare systems. So people have run out of patience for quarantine, for the mass. Now that the states are reopening, they're hitting the beaches and the bars because the whole thing seems overblown to them. I get where they're coming from, but it seemed overblown to us, too, until we hit the tipping point. Maybe they never do. Still, with millions of Americans wanting to go back to normal, that's fueled an incredible rally. This kind of action was unthinkable 2 months ago when the Dow Jones average crashed to the 18,000 level. Dow's now at 25,000, less than 5,000 points away from the all-time high. S&P spent most of the day above 3,000 for the first time since early March. It's like they put Humpty Dumpty back together again. What do investors do when they're convinced things are going back to normal? Simple. They dump the stay-at-home stocks that were working during the lockdown, as well as the drug stocks, the COVID workers and winners. Sell. I don't agree with that, though. Then they move into the money. They take all their money. I mean, these are what hedge funds do. Buy. And they go into the COVID losers that can rack up huge gains if they're really on track for a rapid V-shaped recovery. They buy stocks like Southwest Airlines very well. Disney, my trust owns that, or the cruise lines. The cruise industry was obliterated by the pandemic, but those stocks rallied anywhere from 12 to 15% today because they're big winners if the world really gets back to normal. I told you I like that Norwegian cruise. Same goes for classic cyclical stocks that thrive in a stronger economy. Think Lowe's, Boeing, Caterpillar, Chevron, all the banks. The banks in particular have been sticking up the joint for a long time. A faster recovery is fabulous for them. Fewer bad loans. Every cyclical had its day in the Sunday. The steels, the oils, real estate investment trusts that are linked to shopping malls, the freight forwarders, FedEx. And the home builders, which caught fire today for some incredibly strong new home sales for April, really shocked people. They're supposed to be down about 10%. Actually, they were up slightly. Big part of the rally. Anything that relies on tourism screaming higher, like Estee Lauder, which moves a ton of merchandise at duty-free stores, or the casinos, which seemed dead on arrival not that long ago, and now is trying to get them to pack them in. What's happening here is extraordinary. These companies were right smack in the middle of the COVID blast zone, but they were able to access the capital markets if they needed to, thanks to the efforts of Fed Chief Jay Powell. From the moment the Fed said they would buy distressed corporate bonds by any means necessary, Powell gave business the confidence to tough it out. We've had no major public failures aside from Hertz. That was really a pre-existing balance sheet issue. The new narrative is simple. The recession's ending, and we're looking at a fabulous V-shaped recovery, which brings us to the question, is it true? I think the answer is more complicated, more nuanced. If we don't have a giant outbreak in the states that are aggressively reopening, a big if, then a V-shaped recovery is actually on the table. And if a V is on the table, then you need to own some banks and some cyclicals. But there are other possibilities, which is why I keep stressing that you need what we call a barbell portfolio here, with some recovery winners like the banks or Disney and some recession stocks like the drugs and the foods and the techs that enable you to work from home. I think tech has so many secular themes going for it that you'd be nuts to sell these stocks, especially the semis. When it comes to remote working, the genie is out of the bottle, as you will see it later on in the show. Why not go all in the recovery thesis? Because even though the market's roaring, 38 million people have applied for jobless benefits in the last 9 weeks. Until those people get rehired, we're not going back to normal. For now, they're collecting expanded unemployment insurance. That's an extra $600 a week, but that runs out at the end of July. I think it's been hugely important and really overlooked by the media. By the time that money runs out, we'll need to see an immense amount of hiring. But right now, the only mass hiring we're seeing is from huge retailers like Walmart, Target, Home Depot, Lowe's, and, of course, Amazon, the handful of retail winners who benefit from the lockdown. Lots of small, medium-sized businesses are still struggling here, and I'm very worried about the shock to the system when the payroll protection program runs out of money. We want those paychecks protected. That's why I like a barbell portfolio. The future's uncertain. But you don't have to choose if you use the barbell. Your Disney and JP Morgan and Goldman Sachs will protect you if Take-Two and Eli Lilly get hammered, and vice versa. Even as I think Take-Two's stock is a terrific buyer, down 10 after that terrific quarter. That usually means it goes down another 3 or 4, it stabilizes and starts going higher. But the bottom line, I may not be totally sold on this V. You can't switch directions that fast. Could be more of a U with this much unemployment. But you got to marvel. But you see, marvel at the strength we're seeing, especially in housing and airlines, two industries that appeared to be on death's door not too long ago. Let's go to Mike in Michigan. Mike.
Hi, Jim. First-time caller. Thank you.
Of course.
30-year-old investor here, focus on long plays and growth, Disney shareholder. Is this stock getting out ahead of itself the last few trading days?
No, just it's going to be a rounding error that it went down, that it went down all the way where it is. Okay, it's all the way up to 120. It's spent a lot of time in that 120 area before it fell apart a couple years ago. Yeah, look, I would buy more if this stock went down to 110. How's that? That's my conviction. Tom in Florida. Tom.
Booyah, Professor Cramer.
Thank you.
This is Tommy D. This is Tommy D. from sunny Largo, Florida.
Wow. Nice.
I'm a first-time caller and a long-time listener, and I want to thank you for all that you do for us little guys, even though you've heard that a million times.
No, look, I love it. I mean, I'm still working here. I'm still doing this stuff. It's been like 3,000 shows, for heaven's sake.
Well, keep up the good work, my friend.
Thank you.
By the way, this is a belated birthday present to me. I just turned 70 years old yesterday, so thank you for taking my call.
You're a young man. Let's go to work.
Okay. My stock is BJ Wholesale. I want to know what your thoughts.
Well, it had a remarkable quarter. Now, it ran up too much after that quarter. People went nuts. I think people thought they were going to miss the quarter. So I expect the stock to pull back a bit, but not that much because, boy, they blew it out. You're in good company with that one, and happy birthday. Let's go to Josh in Virginia. Josh.
Hey, Jim. Thanks for your time.
Of course.
I'd like to discuss Corning, ticker GLW. So they have a 4% dividend yield. They have $2 billion in cash with manageable debt. It is an autonomous driving play. They have a 5G partnership with Verizon, but more importantly, the FDA approved a new vial for the first time in 100 years this past October, which was made by Corning. Corning's Baylor Glass will inevitably get significant orders for vials because we're facing a massive shortage. What do you think about ticker GLW?
I have tired of GLW doing nothing. Tired. Now, it fell apart when fiber went away between 1999 and 2000, made a nice recovery. But I can't look at the stock. I can't look at it because it does nothing. And I want a company that does something. You got to do something and not go down, of course, but, go up a little. I'm not going with that one, down 22% for the year. Pete in Florida. Pete.
Hey, Jim. First, I want to thank you. A few months ago, I bought Barrick Gold at 18 when you had the CEO on your show.
He was
great. It went
great.
up to 28, and now it's dropped down to 25. Not long ago, Bank of America came out that gold could hit 3,000 an ounce. Should I hold on to Barrick at 25?
You bet you hold on. And if that stock goes back to 20, we're going to have Dr. Mark Bristow on because that company is the best gold producer. And I think everyone has to have a gold stock or own some gold. Okay, there's a new narrative. I'm not totally sold on it, but you got to marvel at today's strength. On Mad Money tonight, what's really driving the market beyond what we just talked about? I'm going to give you my take on the action. Then I'm revisiting my COVID-19 index, telling you which companies, well, let's say, are less relevant and which ones need to come in. And with the tax filing deadline now July 15th, how is Intuit doing? I'm going to sit down with the CEO after earnings, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.